Last couple of years, one of our go-to sponsors has been KeyCity Capital. And if you go to keycitycapital.com/Hugh, you can find out all about it. I want my disclosures out there. I invested in it, as did the fetching Mrs. Hewitt. We invested in a fund that is now closed. You have to be an accredited investor to invest in KeyCity Capital, and you should get the prospectus and read it closely for whichever fund is now open. Stephen Patterson is their Chief of Client Relations. He joins me now. Good morning, Stephen. How are you?
Good to see you, Hugh. Doing well.
Good. I want to begin by asking you about the record highs we've seen in the Nasdaq and the S&P and the Dow, and whether or not people ought to regret investing in real estate or anything else when the market's been on such a tear. I personally believe in diversification, but what do you think most people think?
Yeah, I think that behavioral economics often works against the average retail investor, right? When the market's sky high, everybody goes and buys. When the market bottoms out, everybody tries to sell. I mean, it's the exact opposite of what the behavior should be. I think what the conversation I've been having with clients and, your listeners when they call us is, listen, you had tremendous run up. We'll sit down and take a look at their portfolio and say, listen, over the last 24 months, you've had 20, 25% growth. That's great, but nothing goes up in perpetuity, whether it's the stock market, whether it's real estate, I don't care what it is. Everything has its highs and lows. And, when we look at a 20, 25% run up, hey, let's take some earnings off the table. Let's talk about diversification and let's get you some tax advantages. Let's get you some other income streams. Let's see how we can make this work for you with earnings rather than investment capital.
Now, Steve, when I invested with you, the interest rates were low, and I just thought it was a very easy decision to make. That fund is closed. Would you tell the audience what your fund is open now, what the next one might be like, and what you put into it in this interest rate environment? Because rental properties are not as easy to acquire as they were 3 years ago when I invested with KeyCity.
No, they aren't. So Fund 12, you came in with Fund 3. Fund 12 is currently open and it is very Texas focused. We have 360,000 people a year from the contiguous 48 states moving into Texas annually. That's before we even begin discussing the southern border, and we know what's going on down there. And so, with the tremendous influx of move-ins into the state of Texas, Texas has just been a natural fit with us. We're a Texas-based company, and so interest rates, as you've alluded to, are up, and so we're doing assumable notes. We don't have anything in the current fund higher than 4.25%. So when we go in and buy a
Wow.
property, we're also buying their interest rate on the loan that they have. And it's fixed debt. We don't have any variable interest rate debt right now because who knows what the Fed's going to do. I think the Fed's about to start cutting rates, and I think the real estate market will explode once again. I don't think they have a choice but to cut rates, candidly, because our federal government's spending money like a drunken sailor. But, fixed debt is where we're at right now, buying assumable notes, and they're performing quite well.
So you go to keycitycapital.com/Hugh, and then you call up Steve or his colleagues over there. I want to make sure people understand this is a tax advantaged investment. Steve, how so?
Yeah. So one of the beautiful things about real estate is that the federal government has built into the tax code that you can take depreciation against the asset. And so even though the value of that asset may be climbing, the depreciation on that asset that we capture, we reflect on your K1. And that K1, that depreciation offsets any taxable gain you have. And so it becomes a very efficient vehicle for you to retain your earnings. Think about it this way. If you have a run up in the stock market, when you go to sell those, you're always going to pay a long-term capital gains. With real estate, same thing. You have a run up in real estate, you're going to pay a long-term capital gain, but that depreciation can offset that gain, allowing you to keep more of your money, which ultimately boosts your overall return. And that's why real estate makes sense in portfolios for accredited investors.
And that's why if you're interested, call KeyCity Capital. Go to the website, keycitycapital.com/Hugh. And then it is Steve's job to talk to you. It may be his job to tell you it's not right for you. It may be his job to recommend it to you. But whatever you do, get the prospectus, read it for yourself. Again, you got to be an accredited investor to be able to invest in KeyCity Capital. Steve, good to talk to you. I want to thank Adam and Harley and Generalissimo